Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in corporate filings. Today we are diving into Fluor Corporation's latest quarterly report. Prepare for a bumpy ride, because this report has some twists and turns that might leave you scratching your head and wondering where their profits went. Let's jump right into it. Fluor, a large engineering and construction company, just released their financial performance for the first 3 months of the year. The report gives us a snapshot of how the company is doing, what challenges they are facing, and what they expect for the future. Overall, the picture is a bit mixed, with some positive signs overshadowed by a major loss. First, the top-line numbers. Fluor's revenue, or the total money they brought in, was about $4 billion, $7 billion during the same period last year. So they are bringing in more money than last year, which is generally good. However, when we look at what it cost them to generate that revenue, it almost ate up all their revenue. We see general and administrative expenses, or G&A, at $36 million, which is down from $59 million last year. It seems like they are spending less on overhead. This part is good. Interest income decreased. This means they made less money on their investments. That could be due to lower interest rates, smaller cash reserves, or just different investment strategies. Now comes the big hit. They had a whopping $393 million loss from their equity method investments. Equity method investments are when a company owns a significant portion of another company, but not enough to consolidate it completely. This massive loss dragged their overall net earnings down significantly. This all culminates in a net loss of $232 million. Last year they had a $40 million profit, big difference, and all of that is because of equity loss they took this quarter. This translates to a loss of 1.42 cents per share. Ouch, last year they earned 35 cents per share. Let's move on to the balance sheet. This is like taking a snapshot of what the company owns and owes at a specific point in time. Their cash and cash equivalents, or readily available money, decreased from $2.8 billion at the end of last year to $2.4 billion. It seems they are spending quite a bit of that cash. Long-term debt slightly decreased from $1.4 billion to $1.087 billion. It seems like the company is ever so slowly trying to pay off their debt. The cash flow statement tells us how cash is moving in and out of the company. We see they had negative operating cash flow, or the cash they have left over to spend after running their core business of $286 million. Compared to negative operating cash flow last year, although still negative, it was $111 million back then. This means that their core business operations are using up more cash than it generated. They spent $142 million on repurchasing their own stock. Companies often do this to try to boost the stock price, but it might be a better idea to allocate these resources elsewhere. Fluor divides its operations into different segments, each with its own performance dynamics. First, the Urban Solutions segment actually saw some growth in profit. They point to increased activity on life sciences projects, a metals project, and design improvements on a highway project. However, there was a drop in the Energy Solutions segment due to project completions and some reserves taken for a project in Mexico. Mission Solutions segment profit went down this quarter compared to last year due to additional reserves booked for a project done long ago. In October of 2022, the North Texas Tollway Authority sued Fluor for damages for allegedly messing up building some retaining walls on a highway project that finished in 2012. In March 2025, the court said that the joint venture owed them $280 million plus interest and legal costs. But the good news is Fluor is working on a settlement, and they expect their subcontractors and insurers to chip in, reducing their final bill. Fluor has a credit facility, a type of loan they can tap into if they need it. As of March, they had not borrowed any money from this facility. They also have some senior notes, which are like IOUs they've issued to investors. The last important bit, executives receive part of their compensation in company stock. This is pretty typical, and it's meant to align the executives' interests with the interests of the shareholders, because if the company does well, the stock price goes up and they make more money. So what's the overall story here? Fluor is facing some headwinds. The loss from their equity investment in NuScale is a big problem, and their core business is consuming cash. However, there are some positive signs like the growth in Urban Solutions and the efforts to resolve the legal issues. One notable opportunity, Fluor highlights a $15 billion performance guarantee. This is essentially the cost of work they promised to deliver, whether it ends up a success or a loss. And we will only know much later down the line. This is just the nature of the business with so many different variables in project timelines and scope. I will also say repurchasing shares when you aren't doing too hot is not a very good way to allocate capital and is more of a PR move than a strategic one. While Fluor does seem to be taking steps to keep the ship afloat, in this report we see some of their core business is not performing and the net losses only paint more red flags. So I give this a proceed with caution and not a strong buy recommendation. Thanks for watching. If you found this helpful, please subscribe, like and comment.